Now that we've discussed credit reports and scores, let's talk about credit cards and understanding credit cards. That is our next unit. So what is a credit card? Definition: a plastic card that you can use to access a line of credit that has been established in advance. A person can borrow up to an established credit limit. So early on, your credit limit might be $500, and it could go all the way to thousands and thousands of dollars, and you can borrow anything up to that point. The credit limit is the maximum dollar amount that can be borrowed. So is a credit card open-end or closed-end credit? We talked about open-end credit is borrowing up to a limit, and closed-end credit is paying the same amount each month, like a student loan or a car loan. So a credit card would be open-ended credit because it's not the same every month. Credit card interest is the rate at which interest is charged, is referred to as the APR, or annual percentage rate. So I'll say APR a lot in this presentation, and that is referring to the interest rate and the interest that you're going to be charged. It's the cost of credit expressed as a yearly interest rate. Interest is charged each month. The balance is not paid in full. So if I were to charge, let's say $120 this month, and I got my bill and I paid the full amount, $120, I would not be charged any interest. But if I only paid maybe $60, then I would be paying interest, whatever my APR rate is, I would be paying that on the remaining balance. So to prepare for her first semester of college, Miranda purchased a new computer for $1,000 and textbooks for $500, spending a total of $1,500 on her credit card, and it's a 15% APR. How much would Miranda pay in interest if she makes the minimum payment? So if she makes the minimum payment, here let's look at this chart to see the full payment is $1,500, and if she pays it off in 1 month, she pays no interest and pays $1,500 total. If she pays $135 a month, it will take her 1 year to pay off the card. She'll have paid $125 of interest, and the total amount was $1,625, so $125 more than what she borrowed. And the minimum payment is $30, so if she only pays $30 per month, it will take her 11 years to pay off this card. She will pay $1,413 in interest for a total of $2,913. So you can see how much more you pay when you pay the minimum payment. And this 11 years is only paying off that new computer and textbooks from her first semester of college. Think about all the rest of her semesters of college and anything else she would charge on her credit card. That's not including that. So it's just a good example to kind of show you how people can get in credit card debt if they only pay the minimum amount. So a minimum payment is due each month the card has a balance. That is all you are required to pay, but obviously not a very good, not a sound financial plan to have to pay that much interest. Credit card, though, can be very helpful. It can help you develop positive credit history. It's very convenient to use. It can protect you from unauthorized charges. It is safer for online shopping than, for example, using a debit card. And there's lots of bonuses and special features that a lot of credit cards have. Maybe airline miles, maybe cash back bonuses. So there's lots of great things for credit cards for sure. The developing a positive credit history. A credit card can positively or negatively impact your credit history. So you want to follow these things. You want to pay the balance in full every month. So you don't want to charge things you can't pay in full. You want to pay your credit card bills on time. You want to be conscious of how your credit cards affect your credit history. And you want to check the monthly credit card statement for errors. So by doing these things, you can definitely impact your credit history positively. It is very convenient. You don't have to carry large amounts of cash. You can use it in emergencies. Might need to use it for a reservation for places. But again, you just want to be conscious not to overspend. That's the temptation of a credit card. Protecting yourself from unauthorized charges. The most you can get charged with is $50 and $0 if it's lost before anyone actually uses it. So it's not the same as losing your wallet and losing all the money in it. It can definitely keep you safer. If the credit card number is used fraudulently, but the credit card itself is not used, again, you wouldn't be responsible for anything. And the $50 is the maximum. So you should report your lost or stolen cards immediately so you're not charged with anything. And check your statements every month. It is safer online shopping. Difference between a credit card and a debit card. Credit card offers more protection against fraud, less liability for unauthorized credit card charges, so it is safer than debit cards. Your money is not connected to a bank account, so nobody can come back and get any of the money from your actual bank, even if you would lose your credit card. So should you use debit or credit when you go to checkout? So let's say I'm checking out at the Piggly Wiggly. If I pick credit, I'll have to sign a receipt, depending on, usually $25 is the limit and how much you'd have to sign. And there's extra liability protection. But if I choose debit when I go to checkout, I'll have to enter a PIN number, and then that money can go right from my bank or credit union, and there wouldn't be a charge for that. So that's the difference when you choose that. Additional benefits, like I mentioned before, you can get cash back, you can get airline miles, you can get warranty for items, travel insurance. Some cards, though, will charge you for these things. There might be an additional fee or a higher interest rate, so you'll definitely want to check that out. So make sure if it's worth it or not. If you don't travel much, then the airline miles might not be worth it to you. Cash back might be more of an option. So again, just check it out. Would you be willing to pay higher or additional fees for higher interest rates to obtain the benefits? Again, you'd have to think about it carefully, because if you are getting higher interest rates, you want to make sure you're paying off your credit card. You don't have to pay those interest rates. And if the fees are more than you're actually getting in benefits, then it's not worthwhile to you. So advantages and disadvantages. Pause the video and think about it. Okay, what's an advantage of credit card and disadvantage? We've talked about some of them already. The advantages are the convenient payment, useful for emergencies, required for a reservation, able to buy big ticket items, protection against fraud, opportunity to establish a positive credit history, and online shopping is safer than a debit card, and receiving bonuses. So you can see lots of positives. There are disadvantages. Interest can be costly if you keep a balance on it. There might be penalty fees. It might be tempting to overspend. And if not used responsibly, it will have a negative impact on your credit score. So definitely advantages and disadvantages. More advantages than disadvantages, but you'd have to be sure that these disadvantages won't outweigh the advantages. So next we're going to talk about credit card offers.